All right, you guys have been wanting a market update. I haven't done one for a couple months. I think last time was early January, maybe I did one. A lot has changed. We've had a pretty substantial correction, what I've been calling a cyclical bear market within a secular bull market. I still believe those things to be true, although the Ukraine war has modified the odds a decent amount here. It's hard to say because there isn't a lot of historical precedents to that war and what's going on with the sanctions there. Some pretty unprecedented sanctions. It's hard to factor all that in. But I still think even with all of that, I still think this is a cyclical bearish period similar to 2015-16, 2018, 2020, COVID crash, and 2011. Those kind of time periods. I think it's very similar to those time periods still my view. Although there is some things that suggest perhaps that's not the case. Perhaps we could have a deeper, like an actual secular bear, like a 2008. There is some things that point to that as a possibility, perhaps a higher possibility than those previous corrections, but I still don't give the edge towards that. I still don't give an edge towards 2008. I still give an edge towards we're in a secular bull, but we're having a cyclical bear within a secular bull. That's still where I lean. I'll get into some of my reasons why, but I probably won't get into every reason. That would probably take a separate video on reasoning why I think we're still in a secular bull very long term here. And if you guys want that, just let me know in the comments, and maybe that'll motivate me to actually do it. But because that could be a very long video. I will link a video from my other channel which talks about why the current time is really one of the better times in human history by most metrics. And of course, when you watch media and you read social media, you would never believe that because it doesn't seem that way, because all we get fed is negativity nonstop. And yes, in many ways, this Ukraine situation, it's very, very sketchy. It does have some similarities to how World War II started. It's not something to be taken lightly, and I'm not taking it lightly. But as a whole, humanity is in a pretty good shape here. Technological progress and innovation is still very high. So there's a lot of things to be positive about, but the last 2 years we had a lot of euphoria, and we're resetting that. Somehow, some way, every couple years, the market finds a way to reset sentiment when it gets extreme. And I don't view this as any different than the reset we had in 15, 16, and 18 during the COVID crash. I don't view this as all that much different. Perhaps there was more euphoria in some areas, certainly in retail areas and put call ratios and things like that. There was probably more euphoria than we've seen maybe ever. But I still don't think it's enough to say this is like a major top we just had, like a 10-year top, a 20-year top. I don't see that as being the case, although I've been wrong many times before. I certainly could be wrong. Now, this chart that we're looking at, kind of basically an all-in-one positioning chart, and systematic has washed out a decent amount, as you can see, similar to how it did 15-16 and the 11-12 situation. Pretty good washout. The discretionary has yet to wash out. Basically, they're flat in terms of z-score. They're probably not actually flat. They have not gotten to levels that we have seen historically in these cyclical bearish periods. And I'll show quite a bit more information, I think, in this that will kind of confirm that, yes, we've had some washout. I think I would really like to see more. There's nothing that says that we have to see any level of washout before this ends. People get stuck on you have to see this or you have to see that, and you don't necessarily have to see anything. It just changes the odds if you see these things. So I would like to see further washout in a lot of metrics, and some of them are pretty washed out, and we'll get into that. The time component. So if we are in a cyclical bear, which is what I think we're in. What I did here, and these aren't exact highs to exact lows. Basically, it was a little bit discretionary how I drew these drawdown boxes. But like, for instance, this 2011, I did include the retest. And once this retest happened, we were kind of off to the races, and it was kind of over. So that's kind of what I did. I wanted to count the number of bars that basically it took from basically high to low retest, kind of the retest of the low. So in 2015 or 2016, we kind of retested here. It wasn't the exact low. It didn't completely take out the low, but I wanted to include as much of the correction as I could, high to low. And it was discretionary how I drew these boxes. Like, for instance, this wasn't the exact high during the 2018 Volpocalypse situation, and then the taper tantrum following that. So I did include this entire period, even this very bullish like run up into late 2018, that's also included. And with doing all that, you get an average of 186 bars or 186 days, since we're on a daily chart, of cyclical bear markets. That's how long they took, basically, the way I drew it, excluding the COVID crash, okay? And currently we're at 51 bars. So excluding COVID, it took 186 bars on average. Including COVID, it took 145 bars on average. And we're still only at 51 bars here. Unless you think we're going to have a quick turnaround like we did in COVID, which I think is unlikely, considering we're in a QT regime and not a QE regime like we were then. In terms of time, I think potentially there's quite a bit more time left in this. I think this could easily take the entire year and maybe part of next year of very choppy sideways. I don't know that we're going to see like a big, huge drawdown like I think many expect to see. I don't know that we necessarily see that, but we could this high volatility sideways, very, very possible to me that we continue to see it. In many regards, I don't think this is over yet. Even though, yes, we had a pretty nice rally at the end of the week or this week, but I still don't think it's enough. I don't think that's the kickoff rally to a new bull. I really think that's pretty unlikely. That's my view. Been wrong many times. We'll see. Okay, I've been asked many times, how do you get DICs in TradingView? I'm going to do another video on this because I know I'll get asked a million questions since I'm showing this is DICs in TradingView, the entire DICs. I'll show you guys. I'll do a video to show you how you get that. It's a little clunky to get it because PineScript's just a little clunky in a lot of ways. But anyways, what I wanted to do is I wanted to do a 20 period moving average of the Squeeze Metrics DICs, 20 period moving average of the block trades, and 20 period moving average of the FANGMAN DICs, which is one of my indicators on TradingView as well. And you can see when you start looking at these one by one, first of all, DICS 20 period moving average, highest we've ever seen. And I know many people don't think DICS works. DICS has a pretty good history. I haven't seen anything necessarily yet that suggests it doesn't work. It's so far working the way it has tended to work in these cyclical bearish periods. You get quite a bit of buying from the dark pools, but it can still take a long time to get the actual bull trend started. You can have very high 20 period moving average and you can still have bearish price action, short to intermediate term. That's not abnormal. We've seen that before. And block trades, okay, so you don't believe in DICS. Well, the block trades are definitely above average right now. As a whole, these have been in a downtrend for years. I'm sure there's some sort of reasoning behind that has more to do with just the way the market functions than anything. But as a whole, they're buying. And obviously FANGMAN. And the FANGMAN DICS, that's your top 20% of the S&P 500. They are definitely aggressively buying here. Not as aggressive as Squeeze DICS is currently, but still, that's good to see those guys back on board. Equal weight S&P is only like 5% off the highs now. So I know there's a lot of breadth is bad out there, and people say all these things about breadth, and breadth was bad. Good. Prior to this, we had that massive breadth divergence, and you can see as S&P was making new highs, RSP was just barely making new highs. It really wasn't keeping up. After that, I mean, equal weight's been holding up pretty good. It's the mega caps that have been getting slammed recently. So breadth, it's a mixed bag, of course, and breadth can be difficult to use at times. You're not seeing a lot of these equal weight charts anymore because, well, it's not as bearish as it once was. So here's one of the many things that, you know, people could look at this and say, you know, this is a comparison to basically what we saw in, you know, the early 2000s. So what this is, and I've shared this before, this is called PE fair value. If you look in the indicators on TradingView, I've published this. This is the Shiller PE10 ratio. This is adjusted for rates. So this accounts for interest rates. So PE10 is high, plus rates are going up, which adds to this basically being, when this line is above zero, kind of basically we're overvalued. And when we get way above zero, we're really overvalued in terms of PE10 in relation as a ratio to rates. So second highest we've ever been in terms of this, but still nothing like the 2000 peak. I decided to do a little back test of this, try to remember how I did this. Okay, so it was the 20-year percentile rank. Currently we're at 94th percentile. So that's what I back tested, 94th percentile, PE10. And when you do that, you get a 435 samples. But really, when you look at this, it's 2021, 2022, and it's 2000 and 1999. So really, I mean, honestly, sample size of 2, more or less. So really sample size of 1, because we don't know what happens yet with this one, right? Although we have seen a decent correction, we haven't seen anything like we saw at the 2000 peak. So I know it says 435, but really the sample size is probably more like 2 or 1. And yes, the last time we saw this, it was not good long term. It's, like I said, it's really sample size of 1 if you ask me, because I didn't remove duplicates on this, and there's a ton of duplicates. So it is the, one of the higher PE10s we've seen in the last 20 years. Last year, I think it got to 100th percentile. So that's, I mean, it is a factor. It's probably a headwind for stocks. It's hard to look at this and go, yeah, this is bullish. But it's probably a headwind for stocks. But at the same time, we've been here before, since 2008, and it didn't necessarily mean the apocalypse. And this was also the highest we had seen since 2000, and we did extremely well since then. With a lot of volatility, which I think volatility is not gone. So if you're a mean reversion trader, I think you're gonna have a really good time for the next, I would say, at least 6 months. If I was just to throw a number out, at least 6 more months of winter ahead of us. The inflation rate. Okay, so yes, I've seen people say high inflation always causes recessions. Well, I decided to back test that as well. 20-year inflation percentile rank very recently with 100th percentile, so it's the highest we've seen in a rolling 20-year period. This is a rolling percentile rank. So recently we saw extremely high, the highest we'd seen in 20 years. Here's the previous dates. Obviously the 70s are in there a bunch, 60s. 2008 got in there, 2000 got in there, 2018 was in there briefly. But keep in mind, let me go back to that before keep in mind, inflation was crazy low for a long time. So, in 2018 when we did, or wait, that was 2008. Even in 2008, like this was still like not that high of inflation compared to what we've seen in the past. And even now, and I know some people say the numbers are skewed by the government, whatever, still not as high as we've seen in the past, according to CPI. But let's see, that was 08 there. Yeah, so 08, yes, this was the highest we'd seen in 20 years, and it wasn't necessarily bullish for stocks. Let's see, I said 2018, right? Yeah, so 2018, it peaked up, but it was still like 2.6% inflation rate, not like super high, right? But so we're much higher now. So this is a factor. This is something we need to consider. By far the highest we've seen in 20 years. That hasn't been bullish historically. And I'd love to show you like everything is bullish because I prefer bull markets and I tend to lean bullish a lot. And we have to factor this in as a definite headwind. 65 sample size when we've seen the highest in 20 years rolling. 1 month, not so great. Your 5-year return is still 28%, but 28% on a 5-year basis is 20% below the average of 50% on a 5-year basis with the entire sample set. So that's a headwind for stocks. We could chop around for a year. This could easily cause us to chop around for a year or two to reset this, or it could mean 2008 with the sanctions that's going on in Ukraine. With Russia, I mean, if that would continue on for a year plus, which is entirely possible. Yes, I think we got to start talking about 2008 at that point. But I think the reason I'm not leaning there just yet is because I think the economy has been pretty strong. Going into this, we had extremely low credit spreads going into this. Financial conditions indexes, if you look at things like that, everything was as good as it can possibly get going into this. So we have a cushion going in that we could easily kind of chop around, reset positioning, reset sentiment, reset valuations, and not have a 2008. It doesn't have to end at 2008. 2008 scenarios require like a contagion, require a credit collapse, And I don't see enough evidence to say like one of those is imminent yet. You know, later in the year, if the sanctions, we start to figure out with these sanctions, the effect it's going to have longer term, it is possible. 2008 is unfortunately higher probability than I'd like to see here, but I still like I said, I still lean towards we're not quite there. I don't see enough to say definitely sell everything, you know, run for the hills, build a bunker. I don't think we're there yet. Credit spreads have made a pretty big move up, but they are still, you know, pretty low. I mean, they haven't ramped up like they did during COVID by any means, or even during the 2018 thing. So, and that's one of many things. Like I said, financial conditions as a whole are still fairly good, but there's some risks out there. We'll have to watch all this closely. 10-2 spread, yield curve, not moving in the right direction, definitely moving in the wrong direction. Has not inverted, will invert at this rate fairly quickly. And historically, this has been a fairly good predictor of not just recessions, but pretty bearish periods for stocks. We got to watch this one closely. This can be, and often is, about 2 years early. This triggered in 2006, and then the rollover in stocks didn't happen until a year later, year and a half. And there are scenarios where this got close to zero or even at zero, and you know we've had big sell-offs, or not sell-offs, but we've had this spread narrow a ton, like here in 94, and it was a false alarm. So don't look at this like a holy grail, like this is an automatic sign of the end of times. Margin debt was a thing that people talked about going into this as this is the biggest bubble ever because of margin debt. And, you know, it kind of depends how you look at it, I suppose. I was hoping to see this updated recently. This only updates once a month. I was kind of hoping to see this come down again this month, but we actually ticked up slightly on margin debt this month. To me, that's not really a good sign. I'd like to have seen this come lower. But, and I've shown this before, and I'm not sure what the best way to look at this is, but this is, and I am a big fan of adjusting things, like I adjust the COT to open interest because open interest changes over time. And adjusting it to market cap, I don't know if that makes sense or not, but when you do that, it's not scary looking. Who knows? I still would say I would just like to see the raw numbers come down more because this, I believe I even have this, I don't. Put it on log, even on log, you know, it was a pretty big move. In previous times, we saw pretty big moves on margin debt, even on long scale, just kind of moving above. If you drew kind of like a linear regression line on this, we're kind of above the linear regression line by quite a bit. I'd like to see it at least come back to the midline of the linear regression trend, basically. If we did that, I think that would be probably enough. And historically, if you backtested, you know, if you had a way to backtest this, when it got extended from the mean, like it kind of has here a few times, it wasn't so good. It wasn't so good. So this is also a headwind for stocks. Short interest was a big talking point leading up to all this. And yes, a healthy market needs skeptics, it needs a wall of worry, it needs bears. And we kind of destroyed the wall of worry. We systematically destroyed shorts the last couple of years, the Wall Street bets and all the stuff they were doing. And we're rebuilding them. Shorts are coming back, but they're still way below kind of long-term averages. So this is kind of your wall of worry in one chart here. It'd be kind of nice to see the wall of worry get rebuilt, and we're doing it. It's just I think there's potential to rebuild it much more than what we have. Short interest on Nasdaq, however, it's pretty high. So there's that. Smart money, dumb money, confidence. This is one thing I've always found with sentiment and with the smart money, dumb money confidence in particular is there's a lot of nuance to it. So usually when you have smart money this bullish and you have dumb money this bearish, you would like to think you'd look at this and it would suggest an excess return that's positive, but it actually suggests an excess return of the next 2 months of negative, which kind of suggests this is the type of thing you only see in like a cyclical bear market. So I'm sure very long-term returns are probably quite good, but the short-term and intermediate term, I would say for 2 months is probably more of an intermediate term. It's actually negative, so that's interesting. And that's, like I said, with sentiment, you can't just look at things and go, everybody's bullish, everybody's bearish, now's the time to buy, now it's time to sell. That's not exactly how it works. There's a lot of nuance to it. Meanwhile, the Fed still has not actually started QT just yet. Still technically easy in that regard, and not in terms of rates, obviously. BofA 2.3, it's definitely getting there, but it's still not at a level you'd like to see, that we, the levels that we got to, like 2016, we got there. We definitely got there during COVID. We got there during 2011. We still are not quite there. We're getting there. I don't think we're there yet. I could be wrong. This thing could go back to a bull. It's possible. I just think it's unlikely. I think there's more time. Now, I do think, I don't know if I've said this yet, I do think we're going to see that typical like cyclical bear or bear market rally that lasts for weeks and convinces many people that the bull's back on, and then you get that lower low. Here's one thing where we have washed out entirely, and that's in surveys. Now this, I've shown this before, but this thing aggregates like all the surveys, so you don't have to look at every survey. You can just look at this one. Several popular, not so popular. Yeah, surveys. There's that. And yes, we are very washed out in terms of surveys. We're washed out in terms of surveys. We're washed out in terms of systematic, pretty well positioning. Like your CTAs and things like that, those guys are all pretty heavily short. But in terms of discretionary positioning, we have more to go, I believe. Fund manager survey, yeah, they're kind of washed out. This is another survey. This is just the fund managers that BofA does. And obviously they're very short tech, or they're very low. They're not short. They're probably short. They just have a very low long exposure to tech. They don't. I wouldn't say they're probably heavily short by any means, but very high cash and very high U.S. exposure. But overall equities exposure also very low compared to history. And I don't remember. I think this is a 10-year. Yeah, 10-year history. I like that they do a longer term history like that, because a lot of these guys will do like 1 year, like Z-scores, and I don't know. I don't think that's worth doing. I think 5 or 10 years, something longer term makes more sense. This is something I didn't really like when to see. Yes, we've had a kind of a nice reset on ETF leverage longs, but during this ramp up this week, they aggressively piled back in. I would rather see them not do that, to kind of think that this rally has some legs. Now, like I said, I think we're eventually going to get a multi-week rally, kind of like you had in 2018. After the vol-apocalypse in early 2018, you had the entire summer we just grinded higher, and then we sold off a lot more later in the year. Okay, there's a bunch of noise outside the room. I had to figure out what's going on. Would have liked to have seen these guys not ramp up their exposure as much as they did, and they dropped out of shorts heavily as well. And inverse ETF volume fell off a cliff this last week. Would like to see that stay elevated longer, although it's been elevated for quite some time now. So, and it's the highest we've ever seen. Of course, all volumes are over time going up, so that factors into these sort of things. Insiders are pretty bullish. They've been buying, and when you adjust for seasonality, fairly bullish. They've been buying. Is that always perfect? Well, prior to 2008, they bought the whole way down. It's not a perfect thing by any means. Nothing's perfect. Since 2008, every time they've bought, for the most part, it has also been a good time to be a buyer for the most part. Fund flows, there's been a lot of fund flows, and maybe it's because of all the cash that was on the sidelines. And that's the other thing that I think kind of potentially potentially could prevent a 2008 type of scenarios. There was a lot of cash on the sidelines, which I'll show that as well. And maybe that's where these fund flows have come in. This was last updated February 28th, so it's a little bit outdated, but they are, there's still a lot of inflows, which I think has kind of supported price a little bit, especially in the S&P 500, and prevented what could have been a much bigger washout in terms of price. Money markets, this is last updated Q4 2021, but it was very high. This is a more recently updated model. February 28th, last updated. It hadn't come down much. There's still plenty of cash out there. Hedge fund exposure, been pretty low for a long time now, so this is bullish. You got to look at this in a bullish manner. I think a lot of this rally, and if this rally continues, which I really don't know, I think there's some signs it could, and we've been selling for quite a while now. We have just red day after red day after red day after red day. You had, nonstop negative news, nonstop negative news events just coming at the market nonstop, and people piling in a bit on the short side. People maybe temporarily move too far to one side of the boat, and now you might get a multi-week, multi-month rally to reset that, but I don't think that'll be the end. And it could, S&P 500 is not that far from all-time high. It could even go to all-time high like it did in 2018. but I don't think that'll be the end. I wouldn't say that's still the end. When we look at that video I did on the setup, I mean, we haven't met all the conditions yet, although we've met a few, and you could maybe argue that we've had that setup if you account for Nasdaq being down over 20% at one point. I don't think S&P ever got down 15%, and that was one of the official setup criteria, but we got really close. I think we were like 12%. But Nasdaq was down 20%. I think IWM I think was down 20%. A lot of stuff was down much more than that underneath the indexes. So you could argue in terms of price retracement we've had it. In terms of breadth thrust, I don't really believe that we've had the true like breadth washout followed by breadth thrust setup yet. So we really haven't had that. We've certainly had DICS do the same thing, but I would say COT dealers they've not gotten net long yet, which we'll show here shortly. So we don't have that set up yet. So we don't quite have, that perfect bull setup where you can somewhat confidently get aggressively long. That being said, I have been layering into low leverage long exposure, not options where I have to deal with theta. Like, unfortunately, a lot of retail just love options, but man, you're getting killed by theta in this market. Just low leverage exposure, not even on futures, mostly just ETFs is what I've been, which is what I did during the COVID crash. About halfway through the COVID crash, I said, man, I just got to buy it because everything I'm looking at says long term. We're probably going to be very bullish. The Fed is shifting towards QE. I just started buying lower leverage stuff, just started buying FANG stocks, things like that. I bought Netflix. I bought a lot of stuff back then. And in my trading account for my long-term core position that I trade around. And then I got the leverage put on later. Once we got the breadth thrust, we got the retrace. I started putting a little leverage on here, but like I said, I've said this before, I was a little scared here still, like everybody else was. Once we got the confirmation back in this next pullback, that's when I kind of got pretty aggressively long, and which is kind of interesting. That's where I started layering in low leverage on the way down. So, and then I rode that core position even through these bigger correction. I still was pretty bullish long term, so I held a lot of that. There were a few times during this I went to like a low leverage or even full cash position, and there was a few times I even went net short during all this. But the idea was never to stay net short; it was usually to get back long with that core position. So that's called trading around a core position, and that's what I do. I trade around a long-term core position, a core thesis that I have long-term. I take short-term trades around that. I'll take day trades, swing trades around that, and I trade also other stocks, individual stocks, commodities and things around that as well. So it's not, people look at my trading and think that I'm just a leveraged investor, and that's not really true. I do a lot more than just that. Equity hedging index, and I think it's pretty basic. It just looks at put call ratios and inverse ETF volumes and things like that. This is something Sentiment Trader put together, and certainly on this we've seen a decent amount of hedging, similar amounts to what we've seen in the past. So like I said, some things certainly are washed out, and this is one that we've seen. And like this, yeah, they hedged like crazy back in here. I don't remember what was going on here, but anyways, this is certainly one thing in the bullish camp. Option speculation index, and like I've said, day traders affect the numbers on this a lot, but this has reset quite a bit. Nice to see that. Yeah, it's not below the green line. It's not down to long-term historical averages yet, but I don't know if we'll ever get there because day traders use call options for leverage. And this is based on volume. This is a volume-based index through the OCC. It's superior to put call ratios because it just shows the side that people are on, but it's still volume-based. So like a day trader that's buying calls and then closing them out at the end of the day, that will reflect in this. So I think this is always going to stay elevated. You're probably not going to get to the green except in a very extreme scenario. So the baseline of this is shifting higher over time, and I think it'll stay that way. So anyways, I would still call this, like in terms of options, I would say this is a pretty good washout we've seen here. So this is another thing that Another reason why, like I said, it's time to probably be a buyer. It's time to layer in, but do it low leverage. Don't be crazy with options or futures at this point. It's not time to do that yet, I don't think. And this is like talking about, this is the actual open interest stuff that's actually being held. This is equity put call. They're starting, it's the highest amount of put open interest in the equity options that we've seen since, well, early 2021. But still far from elevated. I know this is only 2 years of data, that's all I have. After the 2018 thing, they held puts pretty aggressively. After COVID, they held them for a while, but then they went aggressive in calls, and we still haven't seen this completely wash out yet. I was going to show you this index. So the index, they still have not gotten heavy put exposure yet either. In fact, well, I mean, technically it's 1.22, so it's more puts than calls. But that's, in index options, there is almost always more puts than calls. Still, it's the lowest we'd basically seen for years, and just recently. And just now they're starting to actually hold some puts longer term. More evidence that I don't know that we've necessarily washed out yet. COT dealers, still not above the key line here. Very nice move the last few weeks. That's very good to see. So this is one thing with the setup that we want to see, is this above zero. So that hasn't triggered yet. Oh, I was going to show you guys asset managers. So, and when you look at the commercials on the legacy reports, commercials comprise asset managers and dealers. So when we look at this report here, the commercials category for stock index complex, so all the stock index futures. Historically, people look at this and go, when commercials are long, that's contrarian bullish. And usually you'd only see that after pretty major moves lower. Asset managers really have not been in the smart money category, at least not contrarian wise, for a long time, in my opinion. And they actually tend to get very short at major lows. So your commercials, yeah, these guys are going to affect your commercials. So the commercials, like I said, are dealers plus asset managers. And these guys have a tendency to get short at the lows. So when you look at the legacy reports, just keep in mind that really you should be looking at dealers, to be honest. That's because these are the guys that are actually contrarian. When these guys get very long, that's a contrarian signal. And we're getting there. We're not there, but we're getting there. Asset managers are contrarian when they get very short. You want to be a contrarian of that. Or when they get very long, that also can be a contrarian signal. These guys, what I'm saying is these guys are not necessarily smart money. Although, you know, they're ramping exposure up through the entire trend. So during the trend, they make money like a lot of speculators do. They're more of a speculator these days, is what I'm trying to say. Speculators do make money in the middle of the trend, but they tend to give it all back at the beginning and end of a trend, or a lot of it back. That's kind of the idea. Even with that, because dealers have gotten so long, we're almost back to zero on the commercials. So we're not there yet, but we're getting there. And yes, it's no secret that the news has been heavy bearish recently. Not quite like we had during COVID, but certainly as much as we had in 15, 16. Not as much as there, obviously not as much as there. Yeah, the 2011, not near as much as there. So we haven't had like a capitulation in terms of the news yet, but it's certainly moving in that direction. Liquidity premium, when everybody rushes towards SPY, the safety, relative safety of SPY versus individual stocks, that's all this is. A lot more volume in SPY versus the underlying. Basically what this is. You still haven't really seen, although yeah, I guess it was a pretty good spike though. You didn't see nothing like we had in COVID just yet. So we're certainly getting there, but not quite a spike like you would typically see in like a mass panic situation. Could be enough. I don't know. We don't know. Unfortunately, a lot of this stuff you don't know. Like bottoms always look a lot better in hindsight. And could this be a major bottom, like a long-term major bottom? I mean, it's possible. It is possible. I don't view it as likely. Now, could that be the bottom price-wise? Yeah, it's possible, but we probably have a lot more chop sideways in our future, even if that was the bottom there. The term structure, yeah, we had backwardation for quite some time, but nothing like obviously in COVID. But that's That's to be expected there. And if you look longer term, yeah, not quite the extreme spike in backwardation longer term that you would see in even in 2015-16, 2018 we had a bigger backwardation spike. So about 2011, yeah, 2011 we actually, yeah, 2011 bigger backwardation spike. So further evidence we haven't seen like a true like across the board panic yet. Like I said, and I've said this a million times, you don't have to see anything in markets. You don't have to have a widespread panic. It's not a requirement, but it just would change the odds. It'd be nice to see. Part of the reason you haven't seen this because energy's been so good. You haven't had sector correlations spike to 1 with price dropping like crazy. You haven't seen that yet. And I have the sector correlations on Pines or on TradingView. You can look at that. But we really haven't seen that really aggressively hit 1 and just stay pegged at 1 for a few weeks. And it could be, a lot of it could be because of energy. And that, I mean, that's a valid reason why you may not see the entire washout. It's possible. It would just be nice to see. That's all. And yes, yeah, there's a lot of scary stuff. People with this Ukraine situation is terrible. I'm not trying to discount it in any way. But people immediately started talking World War III. And I get it. There's a lot of reasons that it's similar to how World War II started, and I've said that before. But every war since World War II, people have considered World War III. This one probably more likely to develop into that than previous wars, but still probably not likely to develop into World War III. Yet again, just a lot more fear. There's always a lot of reasons to sell. We're rebuilding that wall of worry. It'd be nice to rebuild it more. We're getting there. We are getting there. And that's back to the beginning. I think I covered everything. I am going to do maybe another video on showing how to do that DIX indicator in TradingView before I get bombarded with questions on that. I might put that out actually before I put this video out. If you guys want to see a video on the long-term bullish factors that I think still are the reason why we won't see 2008 here, just let me know in the comments and I'll try to do that sometime. See you guys.